startups have with regards to fundraising. So for Q&A, we have this pigeonhole whereby during the session, if you have any Q&A, you are free to, submit your questions, and we'll actually address all these questions, towards the end of the sessions. So feel free to enter your questions via pigeonhole. So just getting a sense of the profile of the startups over here. So, for these startups that's participating, may I check with you whether you are from the seed stage fundraising round, or you are from the Series A or Series B. So if you could just, enter in the chat box which current fundraising stage you're currently at. So it will give us a better idea for the discussion later. Yep. Okay, so Series A. Okay, so we have a startup from Series A. And I believe there should be quite a number of startups from seed stage and pre-seed. Okay, that's good. So, right now we'll go into, the session proper. So, now I will, get Rohan to introduce himself and also his startup, and also share with us more on, his fundraising journey so far, and, his thoughts on fundraising during this period. Yeah, so Rohan, can you share a bit more?
Awesome. First of all, thanks Yang, thanks Carmen, thanks for the AS team to, organize this, during this time. I'm sure, this is an incredibly opportune time to have this discussion. And, for all entrepreneurs, this is one of the big questions they've been thinking. So I'm glad to be able to help. But I see this is sort of like an intimate setting. So, if you have any questions, of course, very happy to answer that. A little about myself. I graduated from Nanyang Technological University in 2012. And along with my co-founder, we started a tech-enabled education consultancy to help students in Singapore with their college applications, domestically in Singapore and universities around the world. We ran that for 5 years, and that was a bootstrapped business. It was a profitable business. We ran there for 5 years, and we ended up selling that education consultancy to a family office in Singapore as well. And we used the proceeds to start a second venture also in 2017. We launched it in September 2017. And that is, we run that extremely differently, and that's what we're going to talk about. This is a venture-backed company. We've raised 3 rounds of financing. Our last round of financing was last year, but we raised more money in the last few months as well. And the way we run this company is very different from the way we ran the first company, which was a bootstrapped education consultancy. So happy to talk about fundraising, of course, but happy to talk about the differences in running 2 very different kinds of companies, one bootstrapped, one venture backed. And yeah, so what Cialfo does, this is a tech company. Our mission is to help make education accessible for 100 million students globally. We started off by building a SaaS solution, a software as a service solution for high schools around the world. And what this software does is it allows students to store information about their profile, about their interests. It gives them college application data and requirements. It allows them to actually apply to those universities, and also gives features for high schools to be able to communicate with each other. So this is something that we built, but we also started working with colleges, so tertiary institutions who can connect with students onto the platform. We now have, we are headquartered in Singapore, which is where half of our team is based. And the other half is spread over 3 other offices that we have. We have offices in Shanghai, in China, Washington, DC in the United States, and in New Delhi in India. And the customer success and the sales team are based in those 3 different locations. And a Singapore team has founders, the engineers, and of course, other customer success and sales team members. So yeah, so that's, that's sort of, an introduction about us.
Yeah, that's great. Thanks for giving us an overview of CFO, and it's good to find out more about your fundraising journey. So right now we'll go on to our first question that startups usually ask is with regards to fundraising. So one of the questions that they usually ask is this: so what are some of the key things that VCs usually look out for when they assess startups? So understand that before this whole COVID situation happens, there are certain metrics that VC look at, but because of this whole COVID that comes in, there are certain key qualities that VCs are starting to look out for in the startups due to the emergence of a new business model and stuff like that. So could you share with us more based on your fundraising journey, what are some of the key questions that VCs usually ask you when you are doing fundraising?
Yeah, so I'm not going to assume anything, and I'm going to start with talking about just fundraising in general first, and then I will use that as a context to how fundraising we've felt, at least being different during COVID. So typically what VCs look out for at startups also sort of differs at different stages of the company, right? So it was good to know that there were some entrepreneurs who were at the pre-seed stage, some entrepreneurs, at the Series A stage, and what investors look out for in these stages are very, very different. Now, at a pre-seed stage, or even at a seed stage, they're really looking out for two things, in my opinion, or in my experience. One is really the profile and the passion of the founders and the quality of the founders team. So really about founders, right? So is a founding team a good mix of people that would have strengths in anything that the company is looking to do. Now, if it's a technology company, do they have a good mix of engineers, who have experience in building technology products? Do they have hustlers, which are really the people who are selling and going out and bringing clients in. And in one of the books, it's very nicely stated that a founding team is good to a strong founding team has hustlers, hackers, and hipsters. And so triple H, hustlers, hackers, and hipsters. This is for a tech company point of view, and that's really what investors in a pre-seed stage look for. Is the founding team strong enough, and are they passionate about the opportunity or the problem that they're solving? And then the other thing that they look for is, are the investors interested in being part of the journey in the solution that the founding team is working on, right? I mean, you can be working on education technology, which is what Cialfo does. You can be working on e-commerce, on fintech, on logistics, on so many other things like cybersecurity, IoT. Now, some investors are agnostic and they don't really care about which industry. Some investors may care about the sector that you're working on. So they may be interested there. So in the pre-seed, seed stage, I believe that's really what they look for. And the key thing that you would sort of see missing, I haven't mentioned, is the revenue model or the business model, and that's because those things investors understand keeps pivoting. It pivots a lot in the early stages of the company and pivots later. A lot of companies are pivoting during COVID, but because of that companies do pivot a lot in the early stages, they really look for founders and problem that they're solving. Now, when they come to the Series A stage, that changes significantly. Of course, founding team is still very important, and the founding team is still important when the company is going for an IPO. But they are now looking for proof of execution. Now, what does that proof of execution translate to? It translates to different things in different aspects of the business. So on the problem itself, they would not only look at the problem that you're looking to solve, but they would look at whether you've achieved a product market fit. Now, a product market fit essentially means, you are solving a problem, you have a solution, but the product that you've built, is that fit for the market, which means, is the market willing to pay you for the product that you've built? And that's really a product market fit. So they want to see evidence of, product market fit. they want to be able to see significant amount of revenue. So a indication of product market fit is, around $1 million annual recurring revenue. Typically has become sort of the benchmark. That's not, I would say, a hard and fast rule, but around $1 million annualized revenue is considered to be a good indicator for product market fit. Now, of course, you would hear of companies that have raised money, which have raised $10 million, $20 million, $50 million without, um, uh, having any revenue, right? They're pre-revenue and they raise $50 million. But that's few and far between. Most technology companies, they would have to reach that. Then they're not only looking at the founding team, they're also looking at the early management team that you started building. So do you have a track record of hiring strong engineers, a strong sales team? Is there a strong demand for the product that you've built? Are you able to, prove that sort of traction? So that's, what they're looking for in the Series A stage. So it's a lot more metric driven in the Series A stage than in the seed stage where, it's more founder driven. And then in the A stage is different. So I hope that answered the question, Yanling, for what VCs look out for.
Yes, definitely. So may I just throw in a question? So for Series A stage startups, so does VC also emphasize and focus on the path to profitability? Because understand that, during like Series A and seed stage, that is when most startups aggressively reinvest, the capital that they receive and, the revenue that they earn from their startup. So does the VC also emphasize on, what are the plans that the startup have to reach profitability, and at what certain stage can the VC expect the startups to turn profitable?
Yeah, that's a great question. And my answer would have been very different 6 months back and right now. And that is because of the investment climate. So 6 months back, we had come through, the tech community globally had come through a very hot period of tech investing where it was a lot about, growth. And we started seeing that becoming an issue sort of Q4 2019 when, some of the other bigger companies like WeWork and, some of the other companies started having issues of profitability. But there was this huge momentum of, growth at any cost. But I think that has tempered down significantly in the global community, in all ecosystems around the world, where the focus is now a lot more on fundamental unit economics and on profitability. So fundamental unit economics is essentially, what is the cost of acquiring a customer and how much is the customer paying you, right? So in technology terms, it's called CAC, customer acquisition cost, and lifetime value. But fundamentally it means, what is the amount of money that you're paying to bring in a customer, and how much is the customer paying you? And if the amount that the customer is paying you is a lot more than the amount that you are spending to acquire a customer, the unit economics is strong. Typically, in technology terms, your lifetime value should be 3 times more than your customer acquisition cost. And now, so that's fundamental unit economics. At any given stage of the industry environment, your fundamental unit economics should be strong. But now there is definitely a stronger sense of profitability. I don't believe that investors are expecting companies to be profitable at the Series A stage. They would expect them to be profitable a little later, but they want to be able to see the path to profitability. So if you're losing money right now, at what point in the future can you hit the profitability? And can you see that? Will you be profitable by January 2021 or by January 2022? And what would it take for you to be profitable? And you need to be able to communicate that. You need to be able to show that. I would say profitability was always a checkpoint. When they're doing their due diligence, it was always a question that they would ask, but profitability has become maybe the top 5 questions that they would ask. So it just climbed up the ladder of importance, and they would dig deep. They would dig deeper into profitability. Now, again, that depends. That's sort of different in different stages of the company, but expect to have a lot more conversations about profitability.
That's a good point. I totally agree with the point on unit economics. So, unit economics is also kind of, a sign whether the sales and marketing efforts by the startup is efficient and whether they truly have a product market fit. Because, if the startup truly have a product market fit, we should expect to see, the log LTV versus CAC should be, more than 3. So, having a good unit economics will enable the startup's investment to actually be utilized more efficiently within the startup itself. So yeah, it's a interesting point, and I think startups, definitely should focus on building a sustainable business model and achieving, the right unit economics. So yep, we'll move on to the next questions that startup usually have. So during your fundraising journey, what are some of the common questions that VCs ask you when you're doing a fundraising round? I know this question is a bit similar to the previous questions, but you can just generally state what are some of the questions that VC ask.
Yeah, and this is a good sort of follow-up question to the previous question, because the question that they're asking, the VCs are asking, is really to ascertain those things that they look out for, in portfolio companies, right? So in seed stage companies, they try to look at the founders, and they will go deep with the founders' background. They would try to look at what do besides the product market fit, which is a very well-read concept, or problem solution fit. I think sophisticated VCs would try to look at founder market fit or founder industry fit. What that means is, a lot of people, as an example, can solve this problem. But you as a founding team, what do you bring to the table that puts you at an advantage than other founders who may also try to solve the same problem, right? So is it your network that you bring in? Is it your last several years of experience that you bring in? So of course, passion is important, but let's just say passion is a benchmark that everyone needs to have. But outside of that passion, what is the fundamental competitive advantage that you would bring as founders, right? And so they would try to sort of dig deeper into understanding that. Also, the questions like in Series A would start with, what is the problem that you're solving? Questions on the product to see, the solution that you've built. Then they would look at any, data or metrics to see whether your solution is liked by your customers. So they would do reference checks with your customers. They would look at your Net Promoter Score, NPS, that your customers, which is a happiness index of your customers. They would look at testimonials from customers, reference checks. Then, they would look at, what is your addressable market? Now, if you're doing something great, you are solving a problem that is absolutely needed, and you're, great in solving the problem. But if the ceiling for solving that problem is, not very high, which means that, you would quickly grow into being a $5 million company or $10 million company, but you cannot grow much beyond that. It is difficult for VCs to enter and invest. And I can go deeper into, how VCs look at, companies and how their business model works, right? But essentially, the VCs need you. If you win, they need you to be able to win big. So they need, 100x of the investment that they've put in you. If you win, if you lose, you lose, and they are ready. Their model works in a way that, 9 companies would lose. But if the 10th company wins, they need to recover all of the money from their first 9 companies and give them enough of a return on investment. So they need you to win big. So they will look at addressable market, and how big can your company become if you do show signs of success. Then they would go into the business model itself. So yes, your product is successful. What is your business model? Your business model may be consumer, maybe B2B. It may be subscription based. It may be a combination. So it may be freemium, right? So there are all these different combinations. What's your business model? What's your, and then again, unit economics about your CAC. What is your CAC? What is your LTV? Then they'll go into future. budgeting. So what has your financials been? What is your projected financials looking like? Is there enough of a pipeline, sales pipeline, that you would have, that can give them confidence that your budget that you have projected for next year or 2 years later makes sense? Yeah, so that's sort of the initial questions. First two rounds of questioning would be around that, which is typically a conversation with an associate, a conversation with the partner. It's around that. Once you come to the term sheet stage, it goes a lot deeper. So you start negotiating on the term sheet, and you have to give them access to the data room, and they'll give you a due diligence checklist, which can be very extensive. So our due diligence checklist went on for 4 pages. Just the checklist went on for 4 pages. So it can be very, very extensive.
Yeah, so yeah, thanks for sharing. So just on a side note, one observation that I have right now is that I think more and more investors, they are more interested in, a SaaS type of company, software as a service. So if you are a startup in the software as a service type of sector or business model, there's also quite a number of metrics that investors look at. So for example, rule of 40, CAC, LTV over CAC and stuff like that. So yeah, and also total addressable market. So investors usually they will want a startup to be in a growing total addressable market, so that as the industry grow, the startups will naturally grow and capture more market share within the market itself. Yeah, so yeah, right now we'll move on to the next question. So this next question, is something that, startups usually face when they're in the process of fundraising. So, normally they tell us that, oh, fundraising is like a full-time job of a founder, because it can be a very tedious and long process with a lot of due diligence by the investors. So, based on your experience, do you have any advice for the startups on how to prepare for fundraising mentally when they are in the whole process?
Yeah, so I think this is also a very good question, because I think as entrepreneurs you have to choose whether you go the venture backed route, or you go the bootstrapping and profitable from day one route. And I don't think you can try to be in the middle, right? So, and having done both kinds of companies, right, or having run both different kinds of companies, they're very, very different. And when you go the venture-backed route, I think the important thing to remember is that once you get in, there's no coming back. Especially if you raise, the Series A funding, which comes with institutional investors, beyond angel investors. There's no going back. And what I mean by that is, your every round of investors, institutional investors especially, they need returns, and their returns will come when, when a new investor comes in and gives you a higher valuation, or you go for an IPO, or you go for an exit, right? Those are two eventual exits, IPO and M&A. So they need you to continue growing, and they need you to, for you to be able to grow aggressively, you need more venture capital. So once you decide to take venture money, there is no sort of turning back in most cases, right? I mean, theoretically, you can buy back the investor, but in most cases, that's not very plausible. So you have to choose, and you have to be very careful. You cannot be like, okay, I will go try to raise some venture money, and once I get venture money, I don't like fundraising, every 6-12 months, I will go back to bootstrap. No, that's not how it works. Once you decide to go venture, go venture rounds, you have to keep doing that. And as part of that comes excitement of growing fast and being able to defeat a competition, especially if your competition is raising venture money. It's going to be difficult for you to continue running a bootstrap company, because they will have more money, which means that they will be able to attract more talent, and they'll be able to expand into markets faster, build product faster, and do all of those things faster. And so the hard truth is that if you go in the venture funding route, you have to continue doing that, and which means that you have to continue raising funds every 6 to 12 months, depending on what your runway is. But you're not always actively raising money. but you always, have, that your runway is, 12 months or 18 months, 24 months, whatever it is, and that you have to always start preparing for the next round, which means that you have to start building a pipeline for investors. You have to start building relationships for the investors. Typically for Series A, Series B rounds, you can't just go to an investor and be like, okay, I'm raising money, give me some money, right? You have to start building a relationship months in advance, typically 6 to 12 months in advance. And that takes effort. That takes effort from the founding team in building those relationships, having those conversations all the year round. So yes, once you choose to go, being venture backed, you have to continue raising all the year round, or have to be in the mindset of, building conversations, building a pipeline all the year round.
That's a good point. I totally agree on that. So, as a startup, once you go down the venture route, so you have to be prepared to, raise like funding rounds for your current investors to be able to achieve a higher valuation from it. So I think this point will tie in with the next question on how startups can avoid excessive dilution when raising funds. So this is very important if the startups will go to the venture route mode, because if the startups give up too much equity at the start, this will have kind of like a severe impact when the startup attempts to raise higher rounds in the future. So do you have any advice for the startups on how to, avoid excessive dilution? And is there some sort of benchmark of a percentage of equity that the startups should kind of give to the investors for the seed stage startups and as well as the Series A stage?
Yeah, so this is, most sophisticated investors would understand that if they force founders to dilute excessively in very early stages, and early stages being seed, A, or even B, it actually hurts them more than it benefits them. And sophisticated investors who've been doing this for a while will understand, because if by B round or C round, when you're raising money, if founders are diluted to 10% or 15% or 20%, means that at that point, Series C already, when the new investors coming at that round are looking at founders and be like, oh, founders only have 10, 20%, means that they will not be as vested in the growth of the company. They will be more like employees working for a salary and working for a bonus, and not vested in making the share price go up, or raising higher rounds of valuation, higher rounds of and caring about their equity in the company, caring about the share price of the company. They will start behaving more like employees, or they may even start checking out mentally and looking at the next opportunity or next startup. So you would have those aggressive investors, or not sophisticated investors, that will try to be a loan shark, or try to be a shark and try to get as much equity as possible in seed or A level, but it will end up hurting them as much as it hurts the founders. So if you have investors in the early rounds of funding at seed or A, who are pushing too hard on diluting you too much, or pushing too hard on just excessive dilution, you should reconsider whether they are the right early partners for you in the journey, because the journey is not short. It's not a 2-year journey. Typically it is a 10-year journey, right? Minimally a 5-year journey if you end up getting acquired. So in a 5 to 10 or 15-year journey, you want early partners who are there with you in a longer term and who are looking out for you. And at the end of the day, once they put in the money, you are on the same side of the table. You're negotiating with them as if they are a different party, but once they put in the money, they are on the same side of the table with you. So so they should recognize that, and you should recognize that while creating the term sheet. And dilution is one part of negotiation. There are many other important parts of term sheet negotiations. Liquidity preference, tag along rights, drag along right, board reserve matters. Those are all extremely important rights that if you focus too much on valuation and not focus on liquidity preference or board reserve matters, you may lose out in the long term. And it may make you feel good about the valuation you got, but actually as founders, you may not earn a lot because of the liquidity preference that you've given to your investors. So there's a lot of things that you have to keep in mind. It's a 360-degree approach, which should be kept in mind as you look to negotiate on the term sheet. To answer your question specifically, what is the sort of, the benchmarks? I think anywhere between 20 to 30% of dilution is a good benchmark in early rounds. So Series A, Series B. Anything above 30% is too high. Anything below 20%, you have to be doing really, really well to dilute less than 20%.
Yeah, thanks for the insightful answer. So I believe the startups, they learned a lot from your sharing. So, okay, we have the last question before we move on to the live Q&A. So last question is, what are some of the available resources on fundraising out there that startups can check out?
Yeah, this is a tricky question because I don't think there is a collated, a set of resources. I mean, there are a lot of resources, but I feel like it also needs to be contextualized, right? So, Y Combinator has a lot of, resources on fundraising. So some of the local accelerators here have, documentation and resources on fundraising. But again, fundraising is very different for different stages of the company, and also very different depending on the ecosystem that you're tapping into. Singapore ecosystem is very different from China ecosystem or the US ecosystem. It's very different from the European ecosystem. So where you're raising money is highly contextualized. So please do not read a bunch of resources that is relevant for China or Silicon Valley and try to hope that you will it's the same environment in Singapore. So as entrepreneurs, you need to be going out a lot. You need to be meeting investors. Your angel investors that you have should help you introduce you to new institutional investors. To be honest, it is not very difficult to set up meetings with investors. The job of the investor really is to meet a lot of companies. So setting up an initial meeting with an investor is not very difficult. Everyone will be ready to meet you. So don't be excessively happy that an investor is meeting you, because that's their job. They need to meet a lot of VCs, startups, and they meet 20, 30, 40 startups a week. But it is about, who carries the conversation further with you. And you should try to have a list of questions ready when you approach an investor. So it's not only that they're asking you a bunch of questions and you come out not knowing anything about this investor that you met. You should have a list of questions that helps you answer some of the questions that we had. What is the benchmark that this investor looks like or looks for, for Series A? So when you're raising Series A, or when you're raising Series A 1 year in advance, you should start talking to the investors that you have in your mind and start talking to them and be like, okay, I want to raise money from you in 1 year down the road. What are your benchmarks that you look for? Then you go to another VC and be like, what are your benchmarks? And you will see there are subtle differences, between them. And then you need to focus on the points that those VCs care about, that you want to investment from. You may be looking at news articles or at conferences and be like, oh, this, VC is extremely exciting and I want to get money from that VC. But they may not be a VC that invests in education, or they may not be a VC that invests in B2B SaaS companies. So, it's really important that you do your research. And so, it may not be a very direct answer that I'm able to give, that, these are the 5 resources. But you need to do your 9 yards and, talk to a lot of investors.
Yep, thanks for sharing. So right now we'll move on to the Q&A at Pigeonhole. So understand that there are some startups who, submitted their questions via the Pigeonhole platform. And we shall take a look at what are some of the key questions that the startup asked. Okay, so we have our questions here. So first question, how much percentage of salary for the founding team is deemed excessive in the utilization of seed funding?
That's a great question. To be really honest, we haven't seen, we did not make use of this metric. What is the percentage of seed funding that should be allocated for management salaries or founding team salaries? I think there are benchmarks out there, what founders can be making depending on the revenue that a startup is making. I think if a startup is pre-revenue and tries to go for seed funding, it may be hard to justify any salary which is beyond a basic minimum that you need to survive in Singapore, right, or wherever you are based. I think it is more sort of benchmarked on revenue than on a percentage of funding. And again, it becomes a negotiation point, as part of your investor, fundraising. Typically, by Series A rounds, $80,000 to $100,000 or $80,000 to $120,000, depending on your revenue, is standard, I would say, per year.
I see. Thanks for answering. So next, we see another question. So I will just skip some of the question. I'll go straight to the question of profitability. So just now understand that we talk about the path to profitability. So this startup asked, in forecasting financial projections for pre-seed stage, when is the business expected to break even or show positive for EBIT over NOPAT? So I will assume this depends on the startup's business model. Different business model have different projections on when the startup will break even. But as a general sensing, could you share with us what do you think is the expected duration of years that the VC should expect the startup to break even?
I think again, it can vary significantly, right? I mean, also depends on how hot your industry is, how hot your community is. If you're running right now during COVID, if you're running a startup which has exposure to retail industry or F&B or travel, it'll be very difficult to fundraise, no matter what your EBITDA is. And if you are in some other industries, say healthcare, for example, and there is organic demand for the next few years, it's a different answer. So I'm not sure if there is a one size fits all for pre-seed stage, but I think what is important for you to be able to show that maybe even different different versions of your budgeting, financial projections, where you like, okay, this is my conservative budgeting, and I don't need excessive financing to continue operating, right? So my unit economics works, and if I raise money, I'm able to grow exponentially. But if I don't raise money, I can still be profitable by the Series A round, for example, right? So I think it's maybe important to show different versions of aggressive and conservative. Yeah, but I think it's difficult for me to say one size that fits all for all pre-seed startups.
That's great. Okay, so we have another questions. So this is a question on valuation. So this startup asks, how do you optimize your valuation for a pre-seed startup?
I mean, again, that's a great question. Valuation for different stages of the company. At a pre-seed startup, honestly, it is more an art than a science. As you go to a Series A, Series B, Series C level, it's all about, your cash flow metrics and, what your churn is, what your ARR is, and what is the projected ARR and all of those things, right? I mean, it's very sort of numbers driven. At a pre-seed stage, I think it's more an art than a science. And, it may end up being more about, how much you're looking for and how much you're ready to dilute, right? So, for example, if you're raising $2 million pre-seed, and you dilute, 20%, for example. So, automatically you're looking at a valuation of about $10 million, right? But if you raise, again, $500,000 with same amount of dilution, 25%, then you're looking at a valuation of $2 million, right? So I think it becomes about a question of how much you're raising and how much you're willing to dilute. And again, what is your revenue at that stage? And but I would say, anywhere between 2 million to 5 million, in most cases makes sense.
Yep, thanks for answering this question. So maybe we'll just take one last question from the startups. So this startup asks, for a mobile app business, in order to obtain seed funding, generally how many users are required that the VCs are looking out for, and how much monthly revenue is required, which is like the ARR?
Yeah, so the mobile app is a tool, right? I think what is more important is that, mobile app means that you're a tech company. But it's very different for, again, a B2B company or a B2C company, right? I mean, you can be a mobile app business and be a B2B company. You can be a mobile app business and be a B2C company. Again, you can be within a consumer company, it can be e-commerce, it can be, education, fintech, and all those are very different, in different markets. So again, mobile app business is not one size fits all, but for how many users are required. Again, it comes back to product market fit than a number of users. So, if you have, say, 1 million users, but nobody's engaged and nobody's paying you any revenue, it doesn't matter. But if you have 10,000 users and 80% of them are daily active users, and all of them, and 20% of them, or even 10% of them are, giving you, say, a monthly subscription, that's incredibly, good. So all of the entire funnel matrix is important instead of just the top part of the funnel and the bottom part of the funnel. Is how many users are getting in, how many are getting engaged, what is your churn, what is your revenue, how many of those, paying customers are, referring other clients, what is the cost of user acquisition, what is the LTV. So all of those things matter when you're obtaining seed funding. We cannot look at one metric in silo and be like, okay, this is what is needed for seed funding.
Yeah, thanks for the insightful sharing. So yeah, I think we have come to the end of the session. So, is there any one last advice you would like to give the startups with regards to fundraising?
One last feedback. I think given we are in COVID, and I didn't really address a lot of COVID related stuff. Generic questions of fundraising is obviously very still relevant. But I think it's important that during COVID we are extra cautious about profitability, but also extra cautious about how much time and how we look at our fundraising. Again, as I said, if you're a business, so one of the VCs, one of our investors actually explained to us really well, how they look at companies, how they look at new companies during this time. And there are this stage of companies that are going to struggle because of travel restrictions or social distancing requirements. And if you're a company that is exposed to those industries or are in that industry, it's going to be extremely difficult. So it's important that if you're a startup in that segment, you pivot or you trim down your costs, trim down your expenses as much as possible and not focus on fundraising. Then there is a second stage of companies where you're getting a tailwind, which means that if you are a healthcare company, there are more people looking to buy vitamin supplements. If you are vitamin C supplements, if you are a dry foods company, F&B company, dry foods, there are more people looking to buy storable packaging food, biscuits or whatever, and there would be a short-term benefit, and VCs would look at that differently. And then there are third stage of companies that are moving the world towards stronger digitalization and causing a structural change in the industries that they operate in. And if you are a company that is causing a structural change in the in the company and actually benefiting in some ways from the COVID scenario, then you are most likely to get VC funding during this stage. So try to be honest with yourself. Which category do you fall under, and focus your effort whether in execution or in the business or in fundraising, depending on that.
Thanks for sharing. So yeah, it has been a very insightful sharing session for our startups. I believe they have learned a lot. So right now I will pass it over to Carmen, who will share with the startups on what are some of the initiatives that ACE is currently supporting our startups for the fundraising side of things.
Thanks, Yanni, and thanks, Rohan. It was certainly an interesting conversation. For those who didn't attend our part one, last week we had Kaising from High Spark who shared with us storytelling techniques to really, help businesses win more revenue. And with the added tips from Rohan today, specific to fundraising, we hope that for those of you who are specifically looking to raise funds during this period, would find the discussion as meaningful as we did. So to those who are looking to participate in fundraising sessions, ACE has a monthly Meet the VC series, of which I think some of you have already participated before. So the next one for July is happening on 17 July. And you will need to sign up using the QR code that you see now. And actually what we will do is we will review back end, and then we will only shortlisted startups will be informed for the session. The next announcement I'd like to do a quick shout out is also on the Back to Work toolkit that ACE has launched recently. Just a caveat, this is community driven, so we have also featured some of the startups within our community that we think have technologies that will be useful to companies, whether it's startups or is it SMEs, to actually manage their business operations in the new normal. So you can again scan the QR code to access it, or you can visit our ACE channels to access this PDF as well. Yeah. Okay, and so that's all from us. We hope that you have enjoyed both the part one and the part two series of this special Kopi Chat edition. If you have attended our ACE webinars, you will notice that it's in a slightly different format this time now, because we decided to spice things up a little. But yeah, let us know if you enjoy such format, and also if there are any relevant topics that you think you might want to know more, please let us know as well. You can write to the email address that's stated on the screen. Other than that, that will be all from me. And thank you, Rohan and Yeling, for the session today.
Okay, thank you.
Bye, everyone. All the best.
Bye. Bye.